Hello folks, hope you all are doing well. We are back with yet another informative and power-packed video. Today's video is about two informative topics. They are why NIO stock can make you rich and best stocks to buy right now. Before getting into the video, please do make sure that you are subscribed to our channel and also have clicked the bell icon near it. So all of you fasten your seatbelts and here we go. Today we will look why NIO markets can make you rich. NIO Inc. is a pioneer in the premier electric vehicle market of China. They manufacture, design, and sell smart vehicles. NIO stock has been on an absolute rampage. What we have witnessed till now is nothing compared to what they will achieve in the following years. If you want to know the reason, then let's move on. NIO, from almost going bankrupt until now, will make you understand that a lot can happen within a short period of time, like just a year. This progress is so much like Tesla, because in fact, according to Elon Musk, Tesla was only 1 month away from going bankrupt, and now they are being added to the S&P 500, which is such a piece of stunning news. So now the market is finally waking up and realizing the potential growth trajectory because NIO is ahead of them. This is so because NIO reported new margins with improved earning per share, with 12,206 vehicles delivered in their third quarter, about 154% in their third quarter in 2019, and making it a total of about 31,340 vehicles delivered so far in 2020. That means they have an increase of 111% year by year. Today, the pandemic is declining and economies all around the world are starting to gradually recover. We can see that by the growing activity indicators in the manufacturing and non-manufacturing sectors, the growth in consumption as a result, the growth of consumer price. Still, while selecting stocks for inclusion in a portfolio, we recommend paying close attention to the main macroeconomic metrics, namely debt burden, growth in revenue, net profit, and profitability. Let's have a look at some companies that may be of interest to investors and show good capitalization growth mechanics. Here are the best long-term stocks to buy. Facebook. Facebook is the largest social network in the world, found in 2004. It is the most searched platform for the market to watch. Facebook is created by Mark Zuckerberg in 2004. Facebook doesn't belong to the trillion-dollar club of mega-cap tech stocks, but it is close enough at about $780 billion. It is the fifth largest publicly traded company in the US, despite only entering public markets fairly. The ratio of liability to the assets of the company in 2020 was 19.5% compared to 13.5% in 2018. The company's assets by the end of 2020 amounted to $159.3 billion and the share capital was $128.3 billion. By this, it is clear that market value is 5 times the company's share capital. The company's revenue rates are very high. This clearly demonstrates it is a growth company, and this can make it the main reason to invest in it. The company has very high profitability indicators. According to a digital survey at the starting of 2020, more than 4.5 billion people use the internet and approximately 60% of them use social networks. From all these pieces of information, it is sure that the growth of the company's trend will continue. This compels us to actively assess the company's future profits. Johnson & Johnson. Johnson & Johnson is an American-based multinational corporation. They develop pharmaceutical, medical-based goods, and medical devices. They have more than 250 subsidiaries around the world. The ratio of liability to the assets of the company in 2020 was 63.8%, compared to 60.9% in 2018. By the above mention makes it clear that the company's debt burden is not very high and the risk of investing in this company is low. The Johnson & Johnson company's assets at the end of 2020 were $174.9 billion and the cost of the share capital was $63.2 billion. So the valuation of the market is 2.2 times higher than the company's assets. It is also worth paying attention to the company profitability indicators, and those are really high. The dividend payout ratio of the company is almost 73%, which makes it attractive from the viewpoint of the inclusion in the portfolio. PayPal stock. PayPal is an American company operating an online payment system that supports many countries. They support online money transfers. It is a buy zone from a cup with handle base, and the buy point is 296.11. The strength line has been improving, reaching the height of 4 months high. It boasts a consistent track record of earnings and sales growth. In 2010, it earned nearly 29 cents per share. In PayPal 2020, the firm's earnings grew 31% to $3.88 a share. As a result of the company's strength, PayPal's EPS rating is the highest possible 99. PayPal customers will be able to use cryptocurrencies to shop at the 28 million merchants on its network starting in early 2020. According to IBD MarketSmith chart analysis, PayPal is trading back above its 50-day moving average line in the recent stock market strength. 3M Company. The 3M Company is a multinational American conglomerate corporation active in the fields of U.S. healthcare, industry, consumer goods, and worker safety. The dividend yield of the company is 2.62% on average over 5 years. The ratio of the liabilities of this company in 2020 was 72.8% compared to that of 69.5% in 2017. The debt load of the company is below 80%, which is not very high. This means that the risk of investment in the company is low. The company's assets amounted to $47.3 billion by the end of 2020 and the share capital of about $12.9 billion. The statement makes it clear that the market value is almost double the share of capital of the company. The company has high profitability and margins, which is indeed a positive factor. The long-term growth of the company's stock is likely to happen as they are considering a partnership with Pegatron to develop a new virtual reality headset. Google. Google is an American-based technology company that is mostly known as the search engine. The company does not pay any dividends and has a fairly low debt burden. This is offset by fairly strong growth in capitalization. The ratio of liabilities to all assets in 2020 was 30.5%. The company's assets at the end of reporting period amounted to $319.6 billion and the worth of the share capital was $222.5 billion. The growth of the company's financial results is high, so the investors will be interested in acquiring Google shares. The price multiples are practically at a level of industry values. Walt Disney Company. Walt Disney is one of the largest media and entertainment conglomerates in the world based in America. It has a capitalization of about $357.3 billion. Its dividend yield is about 1.3%. The ratio of liabilities of assets in 2020 is 58.2%. The company's debt is quite low, which keeps the risk of investing minimal. The company's assets for the latest reporting period were calculated to $201.5 billion. The value of the company's market overestimates by almost 1.8 times. In the last few years, the company has shown up fairly high revenue growth rates. In 2020, the company's revenue decreased by 6%. This is because of the current situation of the COVID-19 pandemic. Investing in the company can cause certain risk factors. The consequences of the company must be taken into account. The statement makes it clear that the growth potential of the company remains the same. AMD, Advanced Micro Devices. AMD is an American company that manufactures integrated microcircuit electronics, which is one of the largest manufacturers of CPU, graphic processors, adapters, motherboards, RAM, chipsets, everything. The company does not pay any dividends. The ratio of liabilities of the company in 2020 was only 34.8%, and in 2018 it was 72.2%. The debt burden is decreasing from one year to another. This statement makes it clear that investors will look at the company's shares positively as the risks are low. The company's assets at the end of 2020 amounted to $8.9 billion and the share capital was worth $5.8 billion. The company is dealing with growth as it is showing a consistently high revenue growth rate. This statement makes it clear that the inclusion of shares in the portfolio is possible. The stocks mentioned above are of much interest to investors to buy for the long term. Some of these stocks are value stocks that are stocks of companies that pay dividends but have good revenue growth. They have the potential of increasing revenue and value in the future due to financial results of their activities. So, that's it for today's video. Hope you found this video informative and enlightening. If you want more such videos, then please encourage us by clicking on the like button and tell us your thoughts in the comments section below. Do share this video with your friends and family. And we will be back with yet another informative video. Until then, stay healthy, stay safe, stay happy. See ya!